Forex Focus brought to you by IG. Taking a look at some day trading definition, letting you know what day trading is and how people tend to think about the general concept in their mind and why they commit any capital to day trading versus, swing trading, which is a more medium-term strategy, or long-term investing. But then also get into some of the high-level strategies that people might commit to day trading here, because of course, it's one thing to understand what the concept is, opening and closing a position during a single trading day. Simple enough, but it's another to think of why you might open a position and close it in the same day. Now, of course, you might say, oh, well, I've before bought Apple stock and it was just a really good scenario, and Apple stock happened to be up 3 or 4% that day. And so I closed it. And so now I'm a day trader. That's not really what we're talking about when we're talking about day trading. That's a lucky coincidence. We're talking about, actual strategies that people put together, where they're going to open and close trades for hopefully profits, but also losses if it doesn't go their way, because they're, from even before they open the trade, attempting to profit from small short-term price movements. And you really have to, if you're going to be a day trader, you're going to have day trading be part of your toolbox here. When you put on a day trade, you have to really stick to that idea. Otherwise, you get this whole mess of, oh, I opened this 2 weeks ago as a day trade, and now I'm down, 5 times what I wanted to make on that trade, and I've been in it for 2 weeks. A lot goes into it strategically when you're talking about day trading, but the simple concept, opening and closing the position, whether that's buying and then covering it by selling before the market closes, or opening a trade by selling and then buying it back by the close. And just to show you what this looks like in a market like euro dollar here, forex market that is one of the larger markets out of not only forex but most asset classes, and open, obviously, forex market is all hours of the day from Monday to Friday. And so you get a lot of day traders from not only the US but across seas, but also US traders that are trading during Asia or during Europe. But no matter what, looking to close new positions by the end of the day, not only because they're attempting to profit from those small short-term movements, but also a goal is to not have risk overnight, so to speak. And you might say, well, Frank, you just told me that the Forex market's open 24 hours between, Sunday night and Friday night. So if it's always open, then I don't have overnight risk. It doesn't close. Well, you do walk away from your platform at some point, right? Or put your phone in your pocket, or shut everything off and go to sleep at some point. And so a big pro of day trading is, I put the positions on. Some are winners, some are losers. But when I do close my computer or put my phone away, I don't have risk that's going in the background, that's in my head, affecting my sleep and everything else. That's a big piece of it. Obviously, the cons being that maybe my strategy didn't work out over the course of a few minutes or a few hours. And here you see, I'm looking at the euro dollar market. It's moving lower from 110.40 to under 110. I try to buy some at 109.80. It doesn't go my way, and so I sell it back at 109.70. I take a 10 pip loss there. But then I get back in below 109.50, and I'm able to cover that for a 10 or 15 pip profit, whatever your mechanics are, around 109.60. And that's just an example, of course. but showing that not necessarily are your day trades always going to be profitable. You take profits and losses. Now, what are some of the most common uses for day trading? Now, data releases are going to almost always be 1A. Could you think of some better times to be day trading a market than a intraday event like an FOMC meeting where the Fed meets to decide on interest rate action at 2 p.m. Eastern, and then they have a conference, a news conference 30 minutes later, and the markets are moving as the Fed chair is talking about inflation and employment and where they see interest rates going. And so much price action with an event like that intraday that is, causing day traders to buy and sell and open and close positions. But also, of course, you have non-farm payrolls, a big employment number that affects interest rates, and that affects stocks and forex and everything else, obviously. And then inflation and GDP growth rates and retail sales and consumer sentiment, still very relevant economic events, but not maybe as high priority as an item as a central bank meeting or a big employment number like non-farm, or a big inflation rate number like the CPI or the PCE. But here you go, the most recent FOMC event, the December FOMC event, the Fed came out and they actually didn't change interest rates, but they started talking about how they might go from hiking rates like they did the last couple of years to cutting rates in the future. And you see a huge move here in that euro dollar market that we've been looking at. That's kind of just the backdrop example for today's conversation. The market moved from below 108 all the way up to 109 at certain points in that single day. And so there's just an example of what you get from a high priority economic event like that. And also huge influence over interest rates themselves, as you could imagine, the bond market, the stock market, commodities markets as well around these events. You also have, of course, technical analysis for these day trading strategies, and some of the most important ones being, moving averages, Bollinger Bands, relative strength index, stochastic oscillator, volume weighted average price, and different volume oriented indicators, very popular, as well as the standard deviation that we'll get to in a second. But I do want to show off the RSI because that's a relatively, none of these are necessarily the best, and none of them should necessarily be solely used to, every time the moving average crosses, I have to do this, or every time the RSI gets to this point, I have to do this thing. But they do help inform when you're seeing large price action events, so less fundamental, like we saw with the economic events, and this more technical with actual just price action events. And RSI is a relatively simple one to view, a good example, because essentially with this one, it does a bunch of math around, standard deviations and where the price is relative to historical prices, and above 70 is meant to convey that the market is, relative to historical prices, overbought. It's essentially could be too expensive, too high. And if you're a trend follower, maybe worth buying and riding that trend higher. And if you're a contrarian, maybe worth selling into, as it's maybe deemed overbought and it's going to come back a little bit. And if it's below 30, it's the flip side of that. It's oversold or it's cheap. And if you're a trend follower, maybe you sell into that and you move with the market moving lower. And if you're a contrarian, maybe you buy that and you try to trade some mean reversion on the market coming back. And what's always, I think, relevant for these type of conversations is take a look at this example. And it's that same day that the Fed came out and were relatively dovish and the dollar fell and the euro rose from 108 to 109. is both sides can be right, right? Like it's really up to you, because this RSI gets above 70 between 2 p.m. Eastern and 3 or 4 p.m. Eastern. You see here on the chart, and the market does when that RSI signal gets above 70, the market continues a little bit further and it pulls back for a little bit. And then in the hours after 4 p.m. Eastern, during the Asian session and European session of the next, I don't know if you want to call it the next day, but in this window, the same day, the market continues further and then also pulls back at certain points. So again, it's not meant to be, it hits 70 and so I have to sell or I have to buy. You feel out for yourself what your strategy is around these things, and then open and close the positions intraday. Because at the end of the day, day traders are really just looking for big moves. And here I have the standard deviation, which is really the basis of almost all technical analysis. Has a standard deviation in there somewhere, especially the Bollinger Bands and the oscillators and anything that's volatility based really usually has the standard deviation. And what we're looking at is just an example of, let's say the standard deviation for that euro dollar market is plus or minus 60 pips. Now, what does that mean? It means a normal day in the market might be up or down 60 pips. And day traders are really looking for just abnormal activity outside the normal, outside the standard deviation. And then from there, you decide for yourself. You can do historical research or just essentially have like a Rorschach test for yourself. Am I a trend follower? Am I a contrarian? And just be consistent with that strategy. And like I started with, make sure that you're taking not only profits, maybe you're taking a 30 pip winner when the market goes in your favor, but take those losses as well, because you don't want those losing day trades to turn into swing trades or turn into long-term positions that outweigh your gains. Because if you have, a 55% or 60% success rate, which I hope you do, of course, that's a very hard thing to do. You don't want to necessarily have a 55% success rate and be taking 2 times as big losers for every winner, because that math doesn't really work out. And here's some last pieces on how to get started day trading, because like I say, it does include mechanics and of course it is likely to include losses. Is have your profits and losses, your exits in general, decided before entering. It makes things a lot easier. And keep your size to a manageable level. Do not overscale. You can't just keep, if you're buying a market, you can't just keep buying it, saying, it's going to come back at some point. Have your size and your exits beforehand. And lastly, if it started as a day trade, try to keep it as a day trade and don't turn those day trades into longer term positions, because that can get really hairy when you work your emotions into it. And now you're maybe liquidating other positions to deal with it. Day trades stay day trades. And that's day trades in general and some strategies around it.